In October 2025, Bitcoin hit an all-time high of $126,296. Wall Street was all in. BlackRock, Fidelity, Brevan Howard, Millennium Management. The institutions that had spent years dismissing crypto as a speculative toy were now its biggest holders, and the financial press couldn't stop celebrating the arrival of institutional adoption. 5 months later, Bitcoin is trading near $67,000, a 47% collapse from the peak. And across the first 8 weeks of 2026, $4.5 billion in net capital has been pulled out of U.S. spot Bitcoin ETFs, the worst start to any year in the product's history. BlackRock's IBIT bled $2.1 billion in 5 consecutive weeks. Fidelity's FBTC lost $954 million. Brevan Howard, once the second largest holder of IBIT, dumped 86% of its position, slashing $2.4 billion down to $275 million. And when a single anonymous whale deposited 1,102 Bitcoin onto Binance at a $55.6 million loss, it became clear the smart money isn't just taking profits, it's running. This is the story of why Wall Street quietly built the exit door before retail investors even noticed the building was on fire. The body count. The scale of this exit is unprecedented in the short history of spot Bitcoin ETFs. In November 2025, the ETF complex logged $3.48 billion in net outflows, the single largest monthly withdrawal ever. December added another $1.09 billion. Then, January and February 2026 delivered the catastrophic $4.5 billion exit. CryptoQuant estimates total cumulative outflows at $8.3 billion since the October peak. Between January 28th and 31st, Bitcoin suffered a violent 15% compression that triggered over $2 billion in long liquidations across futures venues. The price plunged as low as $75,644 on Coinbase, piercing the $84,000 average cost basis of early ETF buyers. By February, Galaxy Research reported that 46% of the entire circulating Bitcoin supply was underwater. On-chain data mirrored the institutional carnage. Blockchain monitors flagged an anonymous whale depositing 1,102 BTC, worth $74.2 million, onto Binance. The entity had bought the stack 8 months earlier at an average of $117,770 per coin, crystallizing a $55.6 million loss. When deep-pocketed holders willingly take 8-figure losses in the open market, this isn't portfolio rebalancing, this is capitulation. March offered a brief illusion of recovery, a 7-day streak of $1.47 billion in inflows, but the structural exit quickly resumed. For the week ending March 27th, spot Bitcoin ETFs posted $296 million in net outflows. Total net assets collapsed 7.5% in days, from $91.7 billion to $84.8 billion. On March 27th alone, the complex shed $225.5 million. Who's selling? The 13F filings tell the real story. These are the mandatory SEC disclosures that force every institutional manager holding over $100 million to reveal exactly what they own. And across Q3 to Q4 2025, the biggest names in finance were systematically dumping. CF Benchmarks tracked the top 40 institutional holders of BlackRock's IBIT. Aggregate hedge fund ownership dropped 28%, from 114 million shares to 82 million. This happened while Bitcoin was still above $90,000. The smart money front ran the collapse. Brevan Howard, one of the world's premier macro hedge funds, gutted its IBIT position by 86%, from 37.5 million shares to 5.5 million. From $2.4 billion to $275 million. D.E. Shaw halved its exposure. Millennium Management trimmed $980 million. Farallon Capital slashed 70%. Symmetry Investments, which held 12.7 million shares through most of 2025, vanished from the top holder list entirely. The mechanical driver was the basis trade unwind. Throughout the bull run, hedge funds bought spot ETFs while shorting CME futures, capturing risk-free yield from the premium. As the market matured and that premium compressed, the trade lost its edge. Desks unwound by redeeming ETF shares and covering shorts. What looks like panic selling in the flow data is largely a mechanical arbitrage closure, but the selling pressure on Bitcoin's spot price is identical either way. The bifurcation is critical. While macro hedge funds evacuated, wealth management platforms actually increased their baseline allocations, trying to dollar-cost average down. Goldman Sachs still holds $2.36 billion in total crypto exposure, including a $1.1 billion anchor position in IBIT. The dichotomy is clear. Short-term, yield-seeking hedge funds are dumping. Long-term fiduciary wealth managers are accumulating. But the sheer volume of the hedge fund basis trade unwind overwhelmingly dictates the negative price action. The ETF machine. The spot Bitcoin ETF was supposed to be the bridge that legitimized crypto forever. And in one sense, it delivered. The complex gathered assets at historic velocity, peaking at an estimated $165 billion in AUM during the October blow-off top. Even after the $4.5 billion exit and the 47% price crash, it retains between $53 and $56 billion in cumulative net inflows, one of the most successful ETF launches in U.S. history. But the architecture created a weapon. Spot Bitcoin ETFs operate through authorized participants, elite market makers like Jane Street and Citadel Securities. The SEC mandated cash-only creations and redemptions, banning in-kind Bitcoin transfers. So when a hedge fund dumps millions of ETF shares, the sponsor, BlackRock, Fidelity, must physically liquidate Bitcoin on the open market to raise dollars for the redeeming AP. Wall Street paper selling translates directly into physical spot market sell pressure. And a brutal fee war is compressing margins further. Morgan Stanley filed for a spot Bitcoin ETF in March 2026 at a rock-bottom 0.14% fee, backed by 16,000 financial advisors overseeing $9.3 trillion in client assets. That undercuts even BlackRock's 0.25%. The product is becoming a commodity, and commodity products attract commodity capital, tourist money that arrives fast and leaves faster. The macro storm. This exit didn't happen in a vacuum. The Fed crushed expectations for rate cuts at the March FOMC meeting, raising its core inflation forecast to 2.7%. Instead of pricing in easing, the market began pricing in potential rate hikes. For an asset that produces zero yield and depends on excess liquidity, higher for longer is a death sentence. Simultaneously, geopolitical friction exploded. Iran war fears drove crude oil higher, feeding sticky inflation. A loaded tanker off the coast of Dubai was struck by Iranian forces. Trump announced 10% tariffs on 8 European nations over Greenland, threatening 25% by June. The resulting tariff tantrum triggered an immediate flight to safety that crushed speculative assets. And the sell-off shattered Bitcoin's central institutional narrative that it behaves as a safe haven. When geopolitical tensions spiked, Bitcoin didn't trade like digital gold. It traded as a hyper-leveraged Nasdaq proxy. Gold surged to record highs. Bitcoin lost 47%. CoinShares' James Butterfill attributed the sustained outflows directly to investor concerns over the increasingly drawn-out nature of the Iran conflict and the prospects of higher inflation. Capital.com's Kyle Rada put it blunter. The charts scream of a market that's run out of puff and may be poised for protracted downside. When Treasury yields compete aggressively and risk-free rates stay elevated, institutional fiduciaries will dump high-volatility, zero-yield assets without sentiment. The opportunity cost of holding Bitcoin simply became too high for allocators navigating a fragile geopolitical landscape. The regulatory squeeze. The SEC rescinded SAB 121 in January 2025, the accounting rule that had blocked banks from providing crypto custody. Its replacement, SAB 122, removed the requirement to record client crypto as a liability. BNY Mellon, State Street, and Citi immediately accelerated custody platforms. On paper, the gates were open, but Basel III capital rules slammed the door shut from the other side. The March 2026 bank capital overhaul imposed a 20% haircut on unbacked digital assets held on bank balance sheets, versus just 2% for payment stablecoins. The Genius Act legalized payment stablecoins under federal law. The market structure bill stalled. The regulatory message was clear. Stablecoins are infrastructure. Bitcoin is speculation. Faced with steep capital charges for holding Bitcoin and an inviting legal framework for stablecoins, Wall Street banks rotated their compliance budgets accordingly. Internationally, the squeeze tightened further. The EU's MiCA regulation imposed comprehensive compliance requirements on crypto service providers, and the UK's FCA proposed classifying major crypto custodians as enhanced regulated firms. Bitcoin became a retail-facing product everywhere. The real institutional money moved elsewhere. Where the money went, the capital that left Bitcoin didn't evaporate. It rotated. Tokenized real-world assets exploded to a $52 billion market cap by early 2026. Tokenized U.S. Treasuries alone scaled to $9.6 billion as institutions sought government-backed yield on blockchain rails. BlackRock's BlackRock Fund, a tokenized money market product, hit $2.19 billion in AUM by April 1, 2026. Capital that once speculated on Bitcoin's price is now earning 5% risk-free, natively on-chain. Even the corporate Bitcoin maximalists shifted. MicroStrategy broke a 13-week buying streak in March 2026, pivoting promotion toward its new preferred stock offering an 11.5% dividend yield. Tesla held its 11,509 Bitcoin, but didn't add to the position. Block Inc., formerly Square, once a vocal Bitcoin advocate, announced $450 to $500 million in restructuring charges, cutting 40% of its workforce to pivot toward AI-native teams. Crypto venture capital hit $20.6 billion in 2025, but the money concentrated in infrastructure, $5.5 billion, into trading platforms and stablecoin architecture, led by Revolut's $3 billion raise and Kraken's $800 million. An unmarked wallet executed a $107 million Ethereum purchase in late March. Smart money hunting yield and staking returns, not Bitcoin's zero-yield price appreciation. What comes next? The analyst community is violently split. Bernstein's Gautam Chugani maintains a $150,000 target, calling this the weakest bear case in history, and insisting nothing broke, no skeletons will show up. Franklin Templeton's Tony Pecor expects all-time highs by year-end. Standard Chartered's Jeff Kendrick projects $500,000 by 2030. But Galaxy's Alex Thorne warns that Bitcoin has never experienced a 40% drawdown from all-time highs that didn't extend to 50+% within 3 months. He identifies the 200-week moving average at $58,000 and realized price at $56,000 as the true historical cycle bottoms. The Coinbase Glassnode Q1 report shows the net unrealized profit/loss metric has shifted from belief to anxiety. Systemic leverage has drained to 3% of total crypto market cap. Bitcoin peaked at $126,296. It's now below $70,000. $4.5 billion left the ETFs in 8 weeks. Brevan Howard cut 86%. 46% of the supply is underwater. The safe haven thesis collapsed in real time while gold hit record highs. The Fed is pricing in rate hikes, not cuts. And the regulatory framework now gives banks a 20% capital penalty for holding Bitcoin while handing stablecoins a 2% pass. Wall Street didn't break up with Bitcoin, it just found something that pays rent.